Hi everyone, and welcome to the Tipper Analytics monthly update for September 2023. I'm putting this presentation together for my family and friends, my hive mind peers in the Visionaries Club community, and our valued clients of the Ainslie Group, including Ainslie Bullion, Ainslie Crypto, and the Gold and Silver Standard. My aim today is to provide some insight into the framework I personally use to trade my current Bitcoin position by talking through my logic and reasoning, showing the updated data and analysis tools I'm referencing, and providing the real-time conclusions that I've come to. I always welcome feedback and discussion, so follow me on x.com/tipperanalytics to find out more and stay up to date or to reach out. Before we begin with this analysis, just a quick reminder that everything I say and show in this presentation is intended for general informational purposes, does not take into account your particular circumstances, objectives or situations, is not financial advice, and you should always do your own research and consider obtaining independent advice before making any investment decisions. Okay, so to start us off, it's useful to understand the big picture framework I'm using that guides my analysis and financial decision making. A lot of it revolves around the work from Michael Howell from Cross Border Capital and how he defines the concept of global liquidity. The reason I rely so heavily on the work of Howell and Cross Border Capital is because they meticulously gather data on all the components that make up global liquidity each month, much more comprehensively than any other source I've been able to access. I find most alternative sources of global liquidity to be poor substitutes because they either only focus on a small subset of countries and economies from around the world, or they focus on a small subset of the important components, with many only discussing central bank money, which you can see is just this part down here. By not using data that is truly reflective of the entire world economy and all the relevant components, many analysts miss out on a significant part of the whole picture and can draw the wrong conclusions. Global liquidity, in the most simple terms, can be thought of as how much money there is in the system. It can exist and be represented in different ways, which is where it becomes complex. But the big picture view is that the total liquidity continues to head up over time as the world creates more fiat currency in various forms. Governments have no real choice as debt burdens continue to grow and need financing. And that's why you see, looking at this chart from back at 1980 all the way up, it's been one direction, up and to the right. So we did have this little pullback that was sort of occurring last year, but even that, you can see in the bigger picture, is a relatively minor blip and is unsustainable in the long run, which will see us continuing up and to the right further. So even though the broader trend for liquidity will always remain increasing over time, as we just saw in that last chart, there are predictable cycles within the creation of all this new currency that are quite consistent. Governments go through periods of slowing down production of new liquidity and speeding it up, attempting to smooth out the booms and busts in their individual economies. And you can see that in this chart really clearly. So this sine wave that's been added over top has consistently performed with what's actually going on underneath, which is the global liquidity cycle over a very long period of time. And you can see particularly towards the end here, so this is what happened coming into 2022. We had the top really aligning quite well with that consistent wave pattern, and the bottom lining quite well with that consistent wave pattern late last year as well. So arguably, the further we've gone on in this cycle, the closer it is becoming, particularly through this current period of monetary expansion and contraction, to the actual underlying sine wave. During these narrower liquidity cycles, periods where the liquidity is rapidly reduced create crisis, and periods where the liquidity is rapidly expanding create speculative bubbles. We care about this because if we can move to the sidelines near the peak of the bubble and stay there during the downturns, then enter the market again near the crisis troughs, we can significantly outperform simply buying and holding assets. Even though most assets were going to go up anyway over the long term, by being out at the right time, we can accumulate more of them at the bottom, as opposed to buying and holding, where you really just remain with a fixed quantity indefinitely. So looking at this chart, you can see we have had consistent periods of asset price booms and banking crisis, or crisis coming when liquidity is withdrawn. And the most recent example of that is what we have seen earlier this year with the banking crisis that started to emerge in the US. So that was very consistent with what we would expect to have found at this period of low liquidity. I really like this chart because the heat map shows a cycle in motion and what it looks like in reality. The area of green dominance shows the period of rapid expansion, while an area of red dominance shows the period of rapid contraction. And as you can see, it's starting to go off to the side of the chart here, but we had a lot of green. It was a really obvious green blob to the left here. That was that period of rapid expansion. And then here you can see last year the real red that was really obvious showing up in a lot of different markets. And you can see down the side here all of the different markets that make that up. So we had that period here where really contraction occurred across a broad cross-section of countries, and that really has continued to this day. So it's sort of coming out of that, however, as we start to see more green emerging in the pattern overall. So some assets are better than others at more accurately reflecting the global liquidity cycle. Even though most assets go up over time in dollar terms as more liquidity is added to the system, gold and Bitcoin act as monetary inflation hedges, which means they are among the best assets to specifically select a trade to take optimal advantage of the cycle. So looking at gold here, you can see the optimal time to buy gold was during the last period here where we had the liquidity cycle low. So during that liquidity cycle low there was also around the time that gold was an optimal time to buy. It was around the low of the gold cycle as well. And it followed it up almost perfectly to the top. So you had the liquidity cycle topping here and gold pretty much topping out with it. Now, what's interesting about this chart is this little anomaly here where we had a little bump up. That was the start of the Ukraine war. So what happened there is people ran to gold as a safety play when the war in Ukraine was starting. But what you need to factor in is that even though it reacted this way, overall liquidity was falling during this period of time. So we already had a sign that the liquidity top was in much earlier, and it was not unreasonable to expect that gold would struggle over the rest of that cycle. And if you line that up with what the cycle's doing here, that's exactly what it did. So it had this little bump, then it sort of returned to its downward trend and actually bottomed out in October, exactly the same time as the global liquidity cycle bottomed out. Since then, we've had a little increase as it's sort of skidding along the bottom here, but the global liquidity cycle does appear to have bottomed. So gold along with that has bottomed, but you would expect potential for much higher gold prices ahead as that liquidity continues to move up in the months ahead. I should also point out on this chart that even though the low was at a higher low than the previous, that's what you would expect because this is the result of more money being in the system. So more liquidity overall being in the system from that initial chart explains why you would expect a higher low. It's the same story with Bitcoin, except Bitcoin's the preferred way to trade the liquidity cycle because of its volatility, while it remains a young asset that's still being widely adopted. The volatility is a feature and not a bug when trading this way, as the extremes allow for much bigger gains in both directions over the course of the cycle. So you can see, again, exactly the same pattern playing out. The liquidity bottomed back here in late 2018, early 2019, and that corresponded with the bottom in the Bitcoin cycle for that particular cycle. And up again, we had the top occur after the top had occurred in the liquidity cycle. So we had this big move up in Bitcoin late in the cycle, but we had already seen the top put in for the liquidity cycle. This is a particularly interesting move because a lot of this was on the back of COVID spending and was retail driven as opposed to a lot of the other moves that we've seen in Bitcoin prior to that. So it really was quite speculative. But the important part to note is that when we got this second top, it was quite clear that liquidity had topped many months earlier. So to expect that to keep going was optimistic at the most, just optimistic to say the least. So you really needed to take that into account, and it would not have been unforeseeable that we would go through this large downtrend that we did, which again bottomed out right here or slightly after, but very close to the bottoming out of global liquidity. So that's where we are in the cycle right now. That low is in global liquidity, and it's corresponded quite nicely with a slight delay with the Bitcoin low being in. And just to clarify also, this price is the average price for the month. So you'll see it's not it's nice and smooth because you're just looking at the single price point, which is the average price across all the prices over that month. So what do I actually do with all of that? I put it together into my strategy, which is on the screen at the moment. So what I really do is I look at that global liquidity index data and the trend direction. I do a bit of macroeconomic analysis to sort of look at where I think we are in the cycle, putting all of that together. And I'm really just building conviction that we've seen the low in the cycle. So when that's in place, then I look a little bit closer to find a specific time to buy, and that's when I purchase. And the opposite occurs at the top of the cycle. I'm looking for all those signs to line up that we're approaching the high in the liquidity cycle. Then I'll be looking for a sell signal to take that opportunity when I see that we've passed that point. So we add these specific trading signals for Bitcoin to fine tune our entries and exits at optimal times. And I'll just quickly go through how this works. So I've added here the global liquidity cycle low, so we can just see where that was on the chart. These numbers are actually cycle analysis that's completed by Bob Lucas. So what he does is effectively looks at a 60-day cycle in Bitcoin and what you can expect. So you can expect somewhere. So the green arrows point out the start of a cycle, and this is saying the previous cycle was 69 days, 45 days, etc. So you're looking to identify that start of the cycle, and the red arrow indicates the cycle high, which will be somewhere during that 60 days. So there's a little bit more of a process around that, but it's not so important. It's more giving us an indication of where we are right now. So currently we think we're probably in a new 60-day cycle that started a number of days ago. We're about halfway through, just to give us an idea of what we can expect next. So we can sort of see this probably going a bit sideways, potentially down a bit, but we will be looking later in the year, but certainly still within this year, for another cycle low to be in that we can get a little bit excited about the potential for it to move higher. So I look at that just to help build that conviction. But what I'm really interested in is my buy and sell signals. Now, these buy and sell signals are constructed really just using a number of technical analysis signals combined together. It's not so important how they're constructed. What's more important is that I'm looking for something to force me to actually get into the market, and remembering that, like, at these lows down here would have been the time where you were most fearful of entering the market, because we'd gone through a long period of it heading down. So I want some sort of signal to really lock it in for me and push me over the line if it aligns with the rest of my analysis. So if we go back and look at this, we had the low in the liquidity cycle back in October. We had plenty of time, because this didn't occur till January, to be watching the market. We'd had a cycle low, we'd had a whole cycle complete where we didn't get a buy signal, and then on this next cycle it had started, and quite early into that we got our buy signal. So all of the planets aligned. It was a really great, strong signal that we could have a lot of confidence in, a lot of conviction to follow and go all in that situation with my Bitcoin allocation for this cycle. So that's where my buy was completed, and that's the process that was used to get to that buy. So I will keep a track of the historical performance. Obviously, I'm only tracking one buy so far, so that's not particularly useful at this stage. But we will see over time, hopefully, this significantly outperform a simple buy and hold strategy, particularly when we get to the top of the cycle and are looking for that way forward. So that's pretty much it. That's the updated application of my strategy and framework in action for this month. But hopefully I've shown you the logic and reasoning behind my active position. But I also look at a couple of other things. So this last set of data and analysis tools that I take into consideration, I think are too narrowly focused to be used to draw the main tradable conclusions from, which is what I just showed you. But they do assist in building conviction on the current stage of the global liquidity cycle and what to expect next in the markets more generally. So the additional data that I look at are US focused specifically, reviewing the current trends in consumer price inflation and government debt linked to bond yields. So just looking at the inflation one here, I like to use specifically the trueflation data, because I find it is a little bit leading over the government reported rate. So the government rate here is 3.7%. That's the official rate. But what we can see from this trueflation data is 2.62%. And more importantly is the chart. So there's a lot of talk in the financial news about sticky inflation. But what we have seen over the last 12 months is really a one-way trend in inflation heading down, and it certainly seems to have bottomed here, probably a little higher than what the Fed, for example, would like. But we haven't seen any aggressive takeoff yet in inflation from these levels. So what that tells us, there are two types of inflation we need to be paying attention to. The consumer price inflation that we're looking at here can only really take off if we get more stimulus directly to consumers. So That's the stimulus checks and things that people got during COVID. I don't think we're likely to see that again soon. It's possible, but I don't think that's likely soon. Where we are likely to see the inflation is in asset prices, which is specifically why we're looking at gold and Bitcoin, because they are those monetary inflation hedges. So overall, you're going to see the inflation somewhere. The question is where you're going to see it. And at the moment, it doesn't look like you're going to see that in this chart of consumer price inflation, which is probably quite bullish for me in terms of my Bitcoin play, because that is where I'm expecting to see that inflation show up. So I also look at, I mentioned the government debt and the US bond market, and particularly yields. And this chart here is one that I've been spending a lot of time looking at recently. So just to break this down for you, this white line is US government debt. And this is over the period of the last 30 years. And as you can see, it's a one-way trajectory as well, up and to the right. We continue to see more debt being issued by the government. And that's inevitable, really, because they need to issue more debt to pay off the interest and the old debt. It's a one-way cycle. But what I'm particularly interested in here that I don't see too many people analysing in enough detail, for my liking at least, is what's happening with this red line, which is the Fed funds rate. So we've seen a very rapid increase in the rate that the US is charging, so the interest rate the US, the official Fed funds rate that they issue. But what we have seen for a period of time here is the rates that you're getting on government bonds. So if you look over here, I've got the 2-year, 20-year, 5-year, 30-year, 10-year, all the different government bond durations that you typically can buy and see. All of those are still the yield that you get on those bonds is still well below the current US Fed's funds rate. Now, that's problematic, because what you would expect and what you see most of the time is that the red line is at the bottom. And the reason for that is if you're buying government debt, so if you're buying these bonds, you would expect to be earning a yield above what you can get basically at the cash rate. So this, if you think of this as putting money into your bank account, the sort of rates you could get at your bank account as a general rule, you would expect to be getting paid what they refer to as a term premium for holding the additional risk. Not that it's a particularly risky asset, that's the whole point of government bonds, but holding over a long period of time is risky. So for that duration, you expect to be earning a return. And the way the market is set up at the moment, you're not getting an additional return for taking on that additional duration risk. Now, that's problematic and is unsustainable, because what we know, and you can see clearly, is over time that one way or another will correct. So it will mean revert and correct. So either these lines all end up above here, which means that the bond yield rates go much higher, which creates a lot of problems for the government to finance all of that debt, or we see the official rates have to come down and the Fed starting to cut rates. So either of those outcomes is possible, but we've heard from the Fed saying that they want to keep this higher for longer. So if we believe what they say, which raises a whole heap of other questions, but if we believe what they say and that rate's going to stay there, we're going to see these additional yields come much higher. And that gives us a bit of an indication that there's some turbulence and some pain ahead in the markets as they come to terms with those higher rates. So overall, that's not necessarily negative for my Bitcoin trade, because out of that chaos, I think assets like Bitcoin and gold will do very well. Also, it's probably what causes the liquidity cycle to really push much higher when they have to come in and fix that one way or another. And one way they could fix it is by buying the bonds themselves, which is effectively quantitative easing, some form of yield curve control. The government will have to do something at some point if these get out of control and start moving too much higher. So overall, that's quite positive. So just to end up, my final thoughts on all this, I really like this diagram. People generally are quite bearish, I find, when I'm speaking to them about what's going on in the crypto markets, because we've been through a long winter, been down for a long time, and they see the potential with economic uncertainty ahead, like that last chart I showed you, for one more dip. So they're moving out of the market and trying to protect themselves because they just don't want to experience that again. That's fine. Why I put this graphic up here, though, is because I feel that really is the riskiest thing that you can do at this particular juncture, with all of that evidence I've presented that the low of the liquidity cycle is in and the expectation for much higher prices ahead, that the risk is actually to the upside. One example would be if these ETFs are approved. So in the Bitcoin space, we're expecting ETFs to be approved in the US that could overnight have a considerable upside move in the price of Bitcoin. So the risk seems to me to be skewed to the upside, and the risk of being out of the market is like this example that you see on the screen, right? That is the picking up pennies in front of the steamroller. Yes, you may be able to scalp a little bit of extra profit, but the bigger risk is that the market takes off and gets away from you, and you don't get an opportunity to get back in without the prices being much higher. And we don't know. You could effectively argue there's unlimited upside potential for the price to take off, but limited downside in this environment. So trading on the sort of time frame that I'm looking at, where it's over months and years, not days, it really doesn't make sense to be trading around this right now. It makes more sense to be building a position and just sitting in it, waiting to see that and liquidity cycle further mature and waiting for that signal later to move out. So that's my final thoughts and how I'm looking at it. So thanks for watching my update this month, everyone. I hope that you all find it valuable for me to step you through my process in this format. It's a little bit different to how I've done in the past, so hopefully useful. As I mentioned at the start, I always welcome feedback and discussion, so follow me on x.com/tipperanalytics to stay up to date, or reach out if you've got any questions or comments. Certainly will take them on board to refine this process. So that's it for me for today. I'll be back in October with the next monthly update to reassess and identify what's changed. I'll talk to you again then, if not sooner, on X, Discord, or the Real Vision platform. Until we chat again, good luck in the market.